Howdy there, folks. Welcome into this 5-piece. We got a 5-piece nugget to get into here today. 5 little videos for me to react to. First one up here, valuations will continue to come down in current interest rate environment, says this gentleman. I want to hear what he has to say, kind of react to that one. Next one up here, small cap stock valuations on the floor and to rally in Q4. Holy smokers, this is no joke. Small caps have been in a tough place for like at least a couple of years now. So yeah, it would be nice if those could start coming back to life. Mr. Cupertino, Dan Ives, on why he's bullish on mega cap tech going into Q4. Here he has to say, react to that one there. Then I want to react to this one. Samara says, very difficult to take risk in equities a la stocks when bond yields are 5%. In the last video up here is Liz Young. There's probably a lot more risk to downside in the stock market still. So I want to hear what she has to say, react to that, give my opinions and perspectives. Thank you, everybody that supports the channel. Thank you, everybody that subscribed to the channel. I appreciate each and every one of you for being here always. Thanks so much. If you want to support me more, support me on Patreon. That's pinned comment down there. Tomorrow, I am buying stocks in there. You get to see the moves I'm making. And you know what they say? Tomorrow, you get to see the stocks I'm buying tomorrow, and it's only a day away.
Some strong potential for 2024, at least according to our next guest. Joining us right now.
This is devastating. Look at my Tesla glass. Look at that thing, man. It's completely coming apart. It looks like Tesla stock prices looked like since the beginning of 2022.
With his outlook as Ariel Alternative Investments Chairman and CEO Les Brunt. And Les, let's talk about this. I love your thought process on this. The outlook for the markets for private equity really depends on where you stand right now. If you have cash on hand or if you're looking to unload assets, it's a different story.
Absolutely. Very reminiscent in some respects of the 2008-2009 crisis, where those with money have proven to have made a lot more money in the balance year, in the years subsequent to the crisis. And those who had assets that they were holding at that point in time, their returns were substantially lower because there were no buyers, there weren't sufficient pool of buyers for those assets.
So prices have come down.
Prices are coming down.
Does that mean there's a lot of bargains right now, or you think the prices have something to drop?
There's still a bit of a mismatch between seller and buyer expectations. Sellers always want the top dollar, obviously, and buyers always want to fish the bottom of the market. But I do think that given the current interest rate environment, valuations will continue to come down. As people run out of cash and need to do a transaction in order to continue their growth, they're going to have to find ways to do those transactions at valuations which are lower than they might otherwise have expected.
So if you guys don't know what's going on in kind of the private equity market and also the Ponzi capital, the private capital market, like the venture capital space, as far as what's going on there, essentially, is we have an interesting phenomenon in both spaces where valuations are having to come down immensely, really in the VC space and in private equity right now. And it all has to go back to interest rates, right? And at the end of the day, you look at growth stocks last year, the way those stocks got destroyed, they couldn't find a buyer in sight last year. If obviously you look this year, really have value stocks and dividend stocks, they can't find a buyer in sight. If you have problems even in the stock market with some of the most reputable, most investable companies in the world, then believe me, you're going to have a lot more problems in the PE space and certainly in the venture capital space as well, right? And it kind of reminds me a little bit of the stalemate that's going on in real estate right now, where sellers don't really want to drop price too much. Buyers are looking out there, they're saying prices need to drop because interest rates are way higher than they used to be. And so you kind of had this awkward time where it's hard to really make a deal happen.
That is what you could get in the equity markets is maybe below what people had thought before. There's not a lot of certainty there, but it's also if you've got any assets that need to be renegotiated in terms of existing loans that you have out or anything, that all puts some pressure on.
Yeah, look, traditional companies are having a difficult time finding financing at rates which are attractive or that allow them to execute their plans. And so as a consequence, transactions are getting done either with greater amounts of equity or at lower valuations. It's got to be one or the other.
Brian Moynihan was talking yesterday about how right now the IPO market, we've seen a few companies that have come out, but there's still a lot of hesitation with other people being able to roll out companies at this point. And until you basically see the end of rising rates, that nobody wants to move. You want to see where that lands first. Is it the same issue with private equity, or is there something else?
Yes and no. I think the differentiator is that it's larger enterprises, larger valuation enterprises that have the opportunity to drive into the IPO market. Mm-hmm. Less valuable companies don't have that opportunity, don't have that option. And so they've got to find a way to continue to get the capital that they need to continue their growth and development, and that's going to come through the private markets.
Well, Les, I can imagine there's going to be some stress in a lot of companies, which might always be an opportunity for PE, I guess. But I mean, it's tough. Inflation, tough with margins. Look at all these strikes and all these wage gains. There's going to be companies that are dealing with higher interest rates, maybe a slowing economy, a higher cost structure, and you're going to have to come in and restructure and lay people off, probably.
Maybe, maybe not. I'm an old guy, so I've seen one or two cycles, as I'm sure you all have. And we all know that things run in those cycles, right? And so if you are a buyer of assets with a view to holding those assets for a period of time, making your money on compounding as opposed to flipping, then you can ride those cycles. And in this environment, now is a good time to be buying.
Really? Even before everything hits the...
Man, wow, that... You know what that just made me think of? That just made me, oh my gosh. We could be about to go through a very interesting time over the coming many years. Do you know what happened in the 1980s? So back in the 1980s, there was a lot of these like corporate raiders that came in. And a great movie was made about one of those corporate raiders, which was the movie Wall Street. I don't know if you guys have ever seen the original Wall Street movie. Phenomenal movie with Charlie Sheen's in that movie. Martin Sheen's in that movie. And then Michael Douglas, when he was in the prime of his career, was in that movie. And oh, what a phenomenal movie that was. But he kind of plays a part of a corporate raider. And like corporate raiders were very popular in the 1980s. And these were folks that essentially went into companies and they completely restructured them. They laid people off. They did whatever they had to do. And that was coming off of the 1970s, right? Which 1970s was obviously a time period of super high inflation, of unions, of just a lot of issues, and a lot of companies needed restructuring come the 80s. That's where these corporate raiders step in, right? And I wouldn't be surprised if we end up going through a 5 or 10 year period when that becomes very popular again. That's how Carl Icahn made his name, was being a corporate raider back in the day. So, man, that could be intriguing. Yeah, I could see that coming. Probably not right now, but down the road in a few years, I think it could be very popular for a while. I should do that.
But things could be hitting the fan in the next few years.
You would know better than me. I wish I were smart enough to prognosticate that clearly, but...
Well, why does it seem, I mean, of the M&A market, and I don't know if these stats are right, for the M&A market up until about a year ago was about 40% of all transaction volume. And now we're down to, what, 22%? Something like that? Isn't that indicative of a marketplace where the PE world is saying something bad's about to happen because I'm waiting? I'm going to sit on my hands as long as I can?
You've got PE asset owners that are waiting because many of them are fortunate enough to benefit from covenant-light financing, so they're not at any risk of defaulting on their financing as long as they can make their interest payments. But there are other folks who aren't necessarily sponsor-backed currently who need to do a transaction in order to execute on their strategy to take advantage of what they see as the market opportunity. And that's where we love to play. And that's where other private equity firms love to play.
Let's talk about Project Black. What is that and what's your investment thesis?
So ours is a slightly unique investment thesis in that we're looking to acquire either currently minority-owned, most will not be minority-owned enterprises that are mid-market size enterprises that service Fortune 500 Tier 1 suppliers, and transfer them into minority-owned enterprises. There are only 5 black-owned companies with revenues of $1 billion or more in the United States. We'd like to double that number ourselves over the course of the next 5-10 years.
You've already got a couple of deals that you've put to place. One of them is a company called Sorensen. I hadn't heard of that before, but it sounds pretty interesting.
It's a great company. Sorensen Communications is a company that's in the business of providing video relay and closed caption communication services for the deaf and hard of hearing. Happens to be headquartered in Salt Lake City, Utah, of all places. But the opportunity that we saw there was to take a company that was essentially a B2C company that was essentially reliant on the FTC to pay its freight, generate its revenues, and transfer that into a B2B opportunity and capture what we thought was a great market share. So think people like Amazon, people like Microsoft.
I really want to know why he said it's Salt Lake City of all places. Are we still talking about this as like a black-owned company? And that would be surprising if they were in Salt Lake City. I guess so, if that's what he means by that. It was an interesting comment. I'll put it like that.
Want to onboard deaf and hard of hearing employees or engage with deaf and hard of hearing people to expand their market share. find us an attractive opportunity to play with.
It does closed caption, but not on television, like in real life interactions.
Correct.
How does that even work? Do you have to have...
You're asking the wrong guy. I just buy them. I don't run them.
and if you have other targets, like what other types of targets? Maybe the other project that you're working on too?
So we're looking at a variety of different enterprises in a variety of different spaces. We've narrowed our verticals, our areas of interest to about 8. And those 8 areas are driven by conversations we've been having with the Fortune 500 procurement folks in terms of where it is that they see increasing their spend, who would they like to have as a better provider. In some instances, there are companies that they're already dealing with that they think would be advantaged with either greater access to capital or better management talent that represent opportunities for us to acquire and grow.
All right, so let's go ahead and jump into this one. Small cap stock valuations floor to
0.75%. The NASDAQ moving higher, above 1% higher right now. Some big moves to the upside in just the past few minutes, but we're going to kick things off with our chart of the day. Of course, it's the 10-year. The yield ripping higher again right now. Take a look. It hit above 4.65 earlier in the session to touch its highest level in nearly 16 years, right now at 4.6. And really, that's where we have to start this conversation, Shannon. Higher yields, but yet we're seeing a bit of a rally in the markets today. How's that even possible?
Well, because I think we've already been under so much pressure.
How is that even possible, right? How is that even possible? I'll tell you my opinion on that. The reason that's possible is probably where she's about to go with this, in my opinion, is market has definitely been kind of in an oversold place where a lot of these stocks have just been getting devastated, and they kind of need a little rally back to life.
Last week or so, and not to say that that pressure has eased, because if you think about what we're facing right now, we're facing higher oil prices, higher yields, potential shutdown. And
keep going.
Student loan repayments are back. We're in September, which is just a tough time in the marketplace. And so this continued pressure, I think, what you're seeing in today's marketplace is that you're looking at investors saying, okay, we've experienced some of this pain. We have had a pullback in August and September. The third quarter is not going to look as strong. But we still are looking at, over the next 3 months or so, what typically occurs after a tough September. And if you look at the numbers, the last 3 years, we've had a stronger fourth quarter after a weak September. And so there is some historical precedent, I think, for some of the optimism or enthusiasm that you're seeing in a few names today. I think our view is that coming into this year-end period, the confluence of all of these stressors coming at a time when seasonal weakness is already in the market and expected, that's why you're seeing this continued pressure. I think we're going to continue to see we're going to see some oscillation here. We're going to see some rotation. At the end of the day, I think investors are still trying to figure out what is the right price, what is the right valuation at which I should be investing for 2024.
Yeah, also important to note the NASDAQ at 1.1% higher, highest of the day, but also the Russell neck and neck with it, Brenda, right now up over 1%. Generally, small caps are more interest rate sensitive. We're hitting 16-year highs. I mean, make sense of it.
Well, I think these small cap has really not participated at all in the rally that we've seen so far this year. And it's really incredibly cheap. If you're looking for something that's inexpensive relative to other parts of the market, small cap is it. Now,
all right, hold your horses for just a moment. Okay, I do need to say this. Small cap stock's been cheap for 2 years. Okay, so just do keep in mind, if you're thinking, okay, small cap stocks have to rally, they're cheap. We've been waiting for a while for this, okay? It's been like 2 years. So eventually, yes, small cap stocks are going to rally, whether that's, into Q4, into 2024, whether it's 2025, you got to wait. At some point, these babies are going to roll, and they're going to be, it's going to be a fun time for small cap land. But we've been waiting for a while. So I just want to caution everybody that hopes like it's about to happen. We've been waiting for this for years, okay?
I'd say it's cheap for a reason. It's because these companies do have to raise capital, whether it's through a secondary offering or through a bond offering or what have you. So there is some risk there, but you could also argue it's priced in. So we could be seeing some of that. And I think if we look at how that fourth quarter rally might play out, I could see some areas like small cap really starting to act better, especially if we see more trends within capital markets, more IPOs coming to market, more M&A activity. That should create a little bit of a valuation floor for some of those industries companies, particularly if we see some of that action within small cap.
So, Brent, I want to make sure we're not leaving you out. One of the things that Shannon was talking about, all this wall of worry type of things, oil also back above $90 a barrel, down.
Oh, there he is, Mr. Short Hills Capital. Let's hear from Mr. Short Hills. Come on, man.
Now down 0.75%, but still $3 above $90 a barrel. What do you make of the action that we're seeing in the market today? The Nasdaq up over 1% higher despite these higher yields.
Markets are really oversold, first of all. So looking at RSI, looking at all the stats, the market is oversold. If you look at SPY, the 200-day moving average is at 420. We're close to that, right? We're like 430 on SPY. So you've had a really decent sell-off. I think ultimately, though, when you're thinking about positioning over the next 3-6 months, I believe that we are now in a structurally different rate environment than we've been in the past 40 years. And so I still don't think that has made its way through the economy and potentially multiples, because we are a country of credit, whether you look at fiscal, look at corporations, look at individuals. And I think that the only reason that the economy continues to remain strong is the insane amount of fiscal stimulus that we continue to have. But ultimately, I do think that, like the Atlanta Fed GDP number, I think it's at 4.9. I just still think that's too high. I think that will continue to come down, because anytime you have to transact in the market, whether you're an individual buying a car, no one's buying houses, or no one's buying existing houses, or you're a company having to go to the debt market, the cost of capital is exponentially higher than it's been the past 13 years. And so I do think rates matter. And so I think short term, the market's really oversold. You could see a pop here and some opportunity. But I think long term, we're going to continue to struggle with this new paradigm and this new regime of rates, which I do not think is going to go back to the way we were the last 10 years.
All right, Steve, agree, disagree? Will the market continue to struggle with this new paradigm?
Mr. Short Hills.
I think it will. I mean, what we're seeing today is a blip, because you actually saw 10-year yields that were up coming down. So the algo traders, the ARBs are in there just saying, hey, okay, let's buy it, because as Bryn points out on a technical look, short-term technical look, perhaps it is oversold. That, again, is just a blip.
Yeah, so, I think anybody that looks at technicals would have looked at this market going into, especially yesterday, as being a severely oversold market in the short term, right? That doesn't mean we're going to just rally from here on, but at some point in time, you have to kind of get that move the other way. And anybody that I talk to that looks at technicals, I'm telling you, all of them basically were saying yesterday, like, this market's about to bounce for at least a couple trading days. And sure enough, yesterday we hit those lows under 13,000 in the Nasdaq, and then we just bounced heavily, for the last couple hours of trading, and obviously today, right? Alrighty, Cupertino, Dan Ives, what are we talking about here?
Market. The slide that we're seeing from Apple comes from regulatory concerns, actually in China, restrictions over there that might be taking place, but also regulatory concerns here in the U.S. Some thoughts that about 20% of revenue could be impacted with their deal for search with Google. How seriously should investors take this? Do you see this slide continuing? Yesterday, we actually saw Apple dip below 170.
Mm-hmm. Yeah, no doubt. I mean, we're seeing it both, in the EU as well as what we're seeing in the U.S. Look,
what is that outfit, Dan Ives? Okay, anybody that's just listening to this video and you're not actually actively watching it, because I know there's a lot of people that just listen to the videos in the background. Everybody, look at your freaking phone, okay? Look at your computer. Look at whatever you're listening to. Stuff. Look at Dan Ives' outfit, okay? Holy smokers, that's no dang flipping flapjack and jokers. What? I don't know if we're going to Hawaii on vacation or if we're in Miami in the 80s. It's one of the two.
To China, they're gaining share in China. I mean, even if you look at the data over the last 24 hours in terms of lead time. So I think Bark's been worse than the bite there. I think that's actually going to be a positive for Apple, despite what we see with Huawei. Now, when it comes to the regulatory here, look, we're not concerned about that. I think Bark's going to be worse than bite there. I do think that's going to be a long-term sort of headline risk. But I think as we've seen again in terms of big tech.
So I disagree with Dan Ives here. I think, personally, that there's a huge risk to the government side, regulation in the United States, and not really just regulation, but potentially looking at the business from potentially some monopolistic type practices. Seeing what the FTC and the move they're making on Amazon, I'm just like, I'm telling you, you have a way stronger case against Apple. A way stronger case. I've looked at it from every angle. And so it seems like it's just a matter of time. That's my personal opinion.
I think that's really been something that you ultimately, it's a buy.
The scariest thing for Apple is we're talking about this is a company that has like 50% plus market share of smartphones sold, and they control the App Store. I'm just telling you, in this sort of government age we're in, where they're starting to look at a lot of these big dog companies and starting to bring, suits against them, I'm sure Apple has some phenomenal folks that are ready to fight that off, but I'm just telling you, I think it's just a matter of time. If you're going to bring up some of the reasoning around Amazon, which Amazon is such a small fraction of the overall retail market, I'm just telling you guys, there's a lot from a lot of different angles you could bring against Apple.
To the headlines in terms of how that's ultimately played out.
I mean, but pretty steep decline. I know you're saying it's just a headline risk, but we're talking about 20% of revenue.
Yeah, but I think that's something in terms of when you look at Google search and when you look at the China story. I think China ultimately, that's been the hearts and lungs of the Apple story. And if you look at the share gains, I think that's going to continue, despite many of the bears calling fire in a crowd.
We'll have to look at the channel checks as we go on with the new iPhone 15. I also want to talk Amazon and the FTC. Is this just headline risk? I mean, this could be a serious threat to their e-commerce business, claiming monopolistic practices.
Yeah, FTC and Khan, it's sort of the boy that cried wolf. I mean, again, going after big tech. I think the street views this more as a multi-year battle, but I think Amazon's going to come out victorious. I mean, I think when you look at this, I think from a legal perspective, I think many think that there's a lot of flaws here. So I just do not believe that this is going to be ultimately that sort of albatross that hurts Amazon here. Even though FTC and Khan continued black eyes, we saw with Amazon, here. I think we saw with Microsoft, we saw with Meta. I think there's just going to be another step.
All right, let's look ahead to Q4. You're very bullish about M&A when it comes to tech in Q4. We just saw a big deal with Cisco and Splunk. However, Cisco shares are down 4% since that deal. We're also in this higher for longer environment. Can we see a robust M&A situation with this higher for longer environment?
Yeah, it's a great question. I think it's going to be a golden age for M&A.
Even with 10-year at 4.6 right now? I mean, even with other rates at their 2006 levels?
1.2 trillion is the amount of cash that these strategics and financials have. They're not going to the markets in terms of needing to raise capital. I think what you saw with Cisco, it's just going to be the first step. I think you're going to see Oracle, Microsoft, Adobe, and others get more and more acquisitive because of what we're seeing with AI. I mean, this is a transformational 1995 moment. I think ultimately the biggest transformation we've seen in 30 years. It's going to catalyze M&A, and I think it's long overdue. This is just the first step.
All right, so I'm going to put you on the spot. So you're saying there's going to be more M&A. Give us some companies, or at least a company that you think is in the sights of an Oracle or one of these other big companies.
I think cybersecurity is where you got to look. I think you look at names like Tenable. You look at names like Rapid7, Sentinel-1 is another one. Look, I think this is just the start in terms of what we see with cybersecurity as well as cloud. I think strategics and financials, we sit here 6 months from now. I think we're going to look back at this as really the start, not the end of M&A.
Yeah, so I think there's a few interesting acquisition potential targets out in the tech space right now. I think one that comes to mind, and some of you guys might have this app on your phone, is Snapchat. I think Snapchat's been a floundering company in the public markets for many years. It's a company that needs to be acquired. It's not really its own standalone thing. It needs to be acquired at some point in time. I think that's one. Another company that comes to mind is Pinterest. Pinterest is another company that seems like somebody's got to pick them up eventually. They're not really a standalone company. So those are two I think of off the top of my head. I do consider maybe a firm being some, company somebody picks up at some point in time. It's just, do they want to take the risk in regards to a firm? Robinhood, I don't know. I could see Robinhood staying in the public markets, but I think that's always a potential acquisition target that's out there. SoFi probably will stay standalone, but it does feel like, a bigger financial institution that's very well capitalized. If they picked up SoFi, I think it would be a very intelligent decision because SoFi really has the growth, and you kind of just let them be your growth engine and, let them kind of do their thing, and you just kind of eat their losses in the short term. So, but I could definitely see them kind of staying public. But, Pinterest, Snapchat, and really affirm. Those are the three that really come to mind, okay? Alrighty, next one up here. Very difficult to take a risk in equities a la stocks when bond yields are 5% plus, says Samara.
As senior global market strategist for Wells Fargo.
Look at that face. Holy smokes, man. I can't even make that face.
Investment Institute. It's great to have you back. Good to see you.
Absolutely. Thanks,
So, no chance you can close out the quarter on at least a stabilizing note, you think?
There should be some rebalancing flows that, will probably come in tomorrow. Those could maybe put in a little bit of a local low. But again, the thing is, we are going to have a recession probably by the end of the year, right? If you look at what the GDP data this morning showed, the consumer's already slowing. And that's before oil prices, started to do what they've been doing recently.
So you're not looking for seasonality?
I don't agree with that. I definitely think there's a potential recession in 24. I think that's a realistic possibility. End of year, I'm not so convinced of that.
Year-end chase or any kind of surprise resolution to the shutdown or a strike giving Q4 a boost?
Yeah, look, you could have some of those things mitigate, some of the economic weakness, but the tricky part is look at what rates are doing, right? Just today, the 30-year was well north of 480. So the tricky part for investors is what do I get paid in stocks to take that additional risk? And if you can get 5% or close to it on the fixed income side, it's just very difficult to say, I want to take the equity risk.
Are you in the camp that corporate profits have troughed?
Probably on a year-over-year basis, the comparisons are very easy in Q4. So you probably do start to see some of those growth rates start to tick positive, but I think it has more to do with a really tough Q4 last year than a really good Q4 this year.
When we were just coming off the October lows.
That's exactly it.
You were talking about rebalancing for tomorrow, and that's just because it's the end of the month, the end of the quarter.
That's exactly it.
Okay. What should we expect for volatility going into the end of the year when we still have so many unknowns? Carl brought some of them up, of course, but strike and shutdown, student loan repayments coming up. You've got the Christmas holiday. How do you factor in all of that when you're looking?
Okay, before we get into what his opinion is there, I'll just say what she just listed off there is great news. Okay, great news for the stock market. Here's why. When you are very well aware of you got this and this and this and this, and we already watched several of these videos today. They're listing off all these things going bad. We got this, got this, got this, got this. Everybody already knows those. It's already out there, right? Like these aren't new things. Like everybody knows what's going on with the unions, what's going on with the strikes. Everybody knows what's going on with valuations, with interest rates. This is no new news. So that's one of the best things for the market is when you already know all the bad crap. We already know about recession risk. We already know about all this stuff. So for if you want to be a little bullish into year end, I can tell you that's something to be bullish about is the fact that we already know all this crap. Where you got to be careful is when it seems like there's no bad news and then some bad news all of a sudden starts to pop and you got this and this and this. And the market's like, oh crap, like we haven't even thought about this or adjusted for this yet. When it's already all out there, there's nothing out that people don't know about. We know about it all now.
At the landscape for equities?
Honestly, I'm surprised that we were below 13 just a few weeks ago. Again, I think it would be fair to say that the market was kind of whistling past the graveyard. And from here, I think the skew is probably still to the upside. Now, 18, 20, I think that is closer to the historical average. But I would say if there's a risk, it's to the upside.
Is your view so dire that economic activity can really roll here and yet the long end stays elevated?
So because of stagflation, right, because of what oil prices are doing, again, it's not so much that this time is different, but I think you have to at least account for the fact that there's a stagflationary element that you haven't seen, probably since before the financial crisis. And honestly, you really have to go back to the 70s and 80s.
You think this is a repeat of the 70s and 80s? Others argue that was about energy to a large degree and a different mix of geopolitics, certainly a larger percentage of the workforce unionized, COLAs, all of that kind of thing created a flywheel in the 70s that would be hard to replicate today.
When you think about the strikes, when you think about oil, it's probably all the headlines that we're talking about today, right? So, maybe it's not a repeat, but it sure is a rhyme.
So what's your allocation? What percentage of a portfolio now is stocks versus fixed income?
So we're a little bit tactically underweight equities. We think there's better opportunities in commodities. We think we're in a commodity bull super cycle because of really good supplier discipline. We also like fixed income. Again, when you can get that kind of 5.5% on the short end and on the long end, we think that fixed income makes a lot of sense for investors. And then within equities, we like large caps. So, I don't want to come across as, overly negative. Our target for next year is 4,700. So we still think the S&P on this pullback is viable. But we really think that the risk reward starts to flip to more favorable, closer probably to that 4,200 area.
Do you think would-be investors are sitting with cash on the sidelines, kind of watching some of the fixed income areas or even money markets and saying, gosh, this is so much of a lower risk than to play into equities with all of these unknowns that we're talking about?
Well, that's exactly it, right? So if you look at earlier this year and you think about, we were around 4,200, and when you kind of tack on 5%, that's about 4,400, which is actually, we're below that right now. So if you had been in cash and you had been clipping that 5% coupon, you're probably kind of neck and neck with what equities have done, and you've taken a lot more volatility to earn the same return.
Yeah, so, if you're thinking about could this be a 1970s type scenario for this decade, let's just say the 2020 through 2030 kind of decade, where that should scare the living crap out of you if you are only an index fund investor. If you're a stock picker like myself, or maybe some of you guys out there, right? And probably a lot of you guys that are watching this video right now, 30 minutes deep here, right? For a lot of you guys, like the 70s would not be the worst thing at all. Because in the 1970s, you had years where the market just absolutely tanked off a cliff. And then it would come back very nicely. And then it tanked off a cliff. And then it came back very nice. So the index didn't really go anywhere during the 70s. But there were so many insanely great opportunities to buy stocks at extremely low prices throughout the 1970s and get bargain basement prices on so many stocks, which is a phenomenon we're already seeing in this market the last 2 years. You had it with growth stocks last year, right? And this year you're having it with value and dividend stocks. To me, as an individual stock picker, I don't fear that. I'm like, this is amazing. I get to pick up stocks at 5, 10, 15-year lows. Awesome for me. Like, sweet. If you're an index fund investor, you're like, when am I going to ever make some gains here? Okay. So that's just kind of what I think about. I'm like, I don't know. Like that doesn't scare me at all. And then obviously coming out of the 70s, you went into the 80s, when the 80s was obviously a very good time for the markets in general. Liz Young, SoFi, let's hear what she has to say about potential downside risk for the markets.
Is that there are signs of weakness that are quietly creeping into the markets that feel like a series of paper cuts. And that's a pretty good description of what we've seen so far. Joining us to elaborate is Liz Young. She's the head of investment strategy at SoFi. And yeah, paper cuts can hurt, right, Liz?
They can once they get to be a lot at a time. And so far it's been pretty orderly, but it's happening under the surface. So things that are obvious are the VIX has climbed quite a bit over the last month or so. Still under 20.
I was going to say still under 20, which is not historic. Like if you're into trouble periods, that's
it was
not really
it was hovering
flashing.
between 13 and 14 for a long time. Now we're at 18, right? So it's not troublesome yet. But then you look at things like the 50-day moving average rolling over on the S&P 500. The number of S&P members still trading above their 200 days down to 40%. Not crisis levels,
Industrial's
but
a lot
down.
weaker.
Industrial's a lot weaker. During crisis periods or big pullbacks, you usually see that down to 11%, even 3% in COVID. And then things like the relative strength index, which tells us whether or not things are oversold. Doesn't scream oversold yet, but certainly the number of members that are showing as oversold has increased quite a bit, from 5% to 22%.
There's a lot of money in the sidelines, and in part that's because you can make a lot of money by parking in a money market or something. You get 5% or north of that. Those people, those investors are kind of waiting to say, if there's a pullback, do I actually jump in? We're not in correction territory yet. You're close to it.
Yeah.
And maybe people are starting to think, okay, is this the pullback I've been waiting for? What would you tell them?
Well, I mean, that's really the biggest question, right? Is it a head fake? We're down about 7% since that local high at the end of July. I don't think we're washed out yet. I think there's much further to go, especially if yields continue to rise, especially on the long end of the curve. And what we've seen happen with the curve recently is a re-steepening, and that's usually what inflicts pain on stocks. So at these levels and all the metrics that I just mentioned, I think there's probably more of a risk to the downside still. I don't think that this is an entry period. But to your point, you're getting paid to wait, right? There's really no rush to get in at these levels. You get paid 5% to sit in treasuries or in money markets, so why not just wait it out and get a decent return in the meantime?
So definitely agree and disagree with her strategy, okay? So first off, let me get with the agreement, and then we'll get into the big disagreement. So obviously, if you have some cash you should always have some level of cash on the sideline, right? We know what I preach, 10 to 30% cash at all times. 10% if you're having trouble, if you're investing aggressively. 30% if you're having trouble finding deals, right? And certainly with being able to get 5% roughly on your money, that's great. That's phenomenal. But I also disagree with her. She's making it sound like, oh, you can just have all the time in the world, just be so patient, blah, blah, blah. Okay, no. The same thing people were talking about at this time last year. when you had growth stocks, the greatest companies in the world down 40, 50, 60, 70%, right? Now everybody's like, oh man, I wish I could buy Amazon at 80 something dollars. I wish I could buy Meta at $90. I wish I could have bought Tesla at $100. I wish I could have bought Shopify at $25, right? I wish I could have got Netflix at $185. And so these are the sorts of things everybody says now. And we're only a year later, folks. We're only a year later. We're not even talking about 5 years from now, 10 years from now, what people will be saying about they wish they bought, right? So now you got this time period where you got this platter, this, just buffet of value stocks and dividend stocks that are at multi-year lows, if not multi-decade lows. And everybody's acting like you got all the time in the world. Well, I don't know. I wouldn't be surprised if in a year or two from now, people are saying, remember when blah, blah, blah stock was this price? Man, I wish I was buying it. And imagine what they'll be saying in 5 years from now, 10 years from now, 15 years from now. So don't assume you got all the time in the world. You've got to act with aggression in this market, and you should always have some cash on the sideline, earn that yield. That's beautiful. I do the same thing, but I can just tell you, you're not taking advantage of these deals out here every week. You're missing. That's all I'll say about that.
I guess people will say what,
and you'll find out faster than you expect in regards to that.
Catalyst, and what we've been pointing to the last couple of days or last couple of weeks is earnings season's coming up again. What do you expect to hear from those companies? What would you need to hear to say, okay, I feel better about this?
Yeah, well, even with this recent pullback, I still think stocks are priced for a pretty strong earnings season in Q4 and into 2024, expecting about 9% growth year over year in 2024. That seems high to me. If you're expecting margins to continue expanding somehow without cutting a bunch of costs, I just don't think the math quite jives yet. So I think there could be a catalyst in earnings season, but we're not really going to hear a lot of that until about 3-4 weeks from now. You've got inflation data still coming out. We've got the Fed on pause for October just because of the way the calendar works. But there's a lot of economic data that could come out between now and then. I do think that if we start to hear earnings revisions downward for 2024, or if we start to hear companies come out and make it less optimistic that they're going to hit those targets in 2024, that's where you get a deeper correction to multiples.
Yes and no. Once again, it's so you could get a bigger hit to multiples, but on the flip side, then some folks will look at that and they say, okay, maybe we actually finally get this recession out of the way, which means Fed's going to start lowering rates, which means all this pressure on the overall financial system and valuations around, interest rates being high is about to go bye-bye. So then some people will look at that as a positive. So, that's a market for you. It depends upon which angle you really want to look at things, okay? Appreciate y'all joining me as always. Thanks so much for being here, folks. Thank you for being subscribed to the channel. Make sure you join my Patreon. That is a pinned comment down there. I appreciate everybody that joins in there, obviously, and you get to see the moves I'm making tomorrow. Tomorrow, you want to see the stocks I'm buying tomorrow and every week, okay? So definitely check that out. Much love and have a great day.